Greetings, fellow investors. It's been 6 months since oil prices began their epic decline. Investors who followed the consensus of advisors in early 2014 and loaded up on stocks of energy producers are still feeling the pain. Unfortunately, though I wish I could say otherwise, there's another down leg coming for energy stocks this year. And it could well wind up doing far more damage to income investors than the first down leg. That's because the energy sector most at risk is the one the consensus least suspects of trouble: pipelines. Readers have heard us rail time and again about the dangers of following an investing consensus rather than thinking for yourself. One big reason is widely circulated forecasts always project the present into the future. Consider the fluff peddled by some of our competitors in the investment advisory business. After a year of some very hard knocks, they're not so gung-ho about oil and gas producers as they were at the beginning of 2014. But they are almost universally bullish now on owners of pipelines, energy storage, and other fee-based infrastructure. There's a lot I like about this group of stocks. For one thing, the great North American energy boom is far from done, and the massive regional price differences for oil and natural gas prevailing now clearly show there's a need for new transport capacity. Even after oil's fall, hundreds of billions of dollars in new pipeline projects in coming years are still set to line the pockets of sector leaders and their investors. The nasty surprise all too many investors will face this year is that not all pipeline companies will survive the current environment to share in the spoils. They may be down 20% or more from their summer highs, but these pipelines most certainly are not good investments. In fact, they may be among the worst places to put your money now. Just ask the unit holders of Boardwalk Pipeline Partners, who thought they couldn't lose with a high-yielding company with a dividend backed by fee-based contracts. That company slashed its payout by 80% in early 2014. The reason? Robust natural gas production growth in Appalachia all but eliminated the need for long-haul west-to-east pipelines it owned. When its contracts expired, Boardwalk had no chance to renew them at anything close to the previous rate. Management had no choice but to take drastic action to the detriment of its unit holders. Many pipeline companies and MLPs that are now household names emerged largely unscathed from the debacle of 2008-2009, when oil prices fell from over $150 a barrel to barely $30 in late 2008. They lost ground during the sell-off that year, but their contracts kept paying, and they were consequently able to continue paying distributions. In fact, many increased them. And when the market steadied, pipeline MLPs were among the first investments to bounce back, with the Alerian MLP index posting a record 75% plus return in 2009. Judging from what's being said and written in early 2015, many if not most investors and their advisors assume pipeline MLPs will repeat that comeback performance this year, wiping out their second half 2014 decline and much more. That's dangerous thinking for several reasons. First, there are many more energy midstream MLPs now than there were in 2008, and not all of them are on solid ground. The primary reason? Many of the IPO'S minted so successfully last year when MLP mania was in full bloom are focused on specific energy basins and dependent on producers that are extremely stressed by low oil prices. Contracts ensure these midstream company revenues, but only if the producers have the cash to pay. And that's increasingly in question, with oil selling for less than $40 a barrel in areas like the Bakken and the Dakotas. Some of the weaker producers are already trying to shop the capacity they've purchased. Failure to find a sublessor could find defaults that will sink midstream revenue. Second, short-term trading strategies, many involving extremely popular exchange-traded funds, increasingly dominate trading in midstream MLPs. A distribution cut at a weakling, therefore, is likely to have a far more dramatic impact on the offender's unit price than even in 2008, and other weaklings will be hit hard as well. Third, the typical energy company right now is still basing its 2015 capital spending and dividend plans on an average oil price between $60 and $70 a barrel. Getting there will require a jump of 35 to 45% in oil from current levels. The longer prices take to get there, the more likely producers will cut capital spending and dividends even more in 2015, and the more likely midstream cash flows will take a hit from canceled projects, lower throughput volumes, and even contract defaults. The bottom line, fee-based contracts do protect owners of pipelines and other midstream energy assets from the direct impact of falling oil prices. But the greater the hit to their customers, the producers, the greater the odds these midstreamers will suffer at the very least slower growth and at most a default of contracts that will force distribution cuts and even bankruptcies. Now for some good news. You can still avoid these risks and lock in strong returns in energy midstream MLPs for 2015 and beyond. The best in class are protected from this oil spill by their scale and diversification, and because they were first to the party. The major producers that are their customers are stressed by low oil, but they have the deep pockets to persevere. In fact, the longer this environment persists, the greater the opportunity they'll have to buy good assets cheaply from distressed owners, boosting earnings immediately and simultaneously enhancing future profitability. There will be no defaults from this group of producers. For the midstreamers that serve them, that means secure revenue and higher distributions now and opportunities for growth in coming years. Strong midstreamers too will have their acquisition opportunities in the coming months. And like the stronger producers, time is on their side as the low oil price environment weakens the exposed and the leveraged. The likely flashpoint for a midstream meltdown will almost certainly be one of the dozens of newly minted MLP IPO'S that were so popular during spring and summer of 2014. These launched with great success, largely because so many investors still see midstream companies as risk-free. Investor complacency certainly isn't shared by the energy industry. In fact, expectations of a blow-up at one of the small and weak are rapidly rising. And when the disaster inevitably strikes, the fallout will be swift and devastating for unprepared investors. I can promise you that won't be the case for readers of Energy and Income Advisor. In early 2014, we forecast a sharp decline in oil prices and rolled back our positions in the most leveraged producers. Rather, we focused last year on stable midstream and well-positioned downstream energy distributors and refiners that have profited from falling oil. Now we're preparing for what investors are likely to eventually call the great midstream shakeout of 2015. We're using the lower prices after the autumn sell-off as a chance to buy the best in class midstreamers cheap. And we're using the bounce we've seen in January to sell what's vulnerable. Our list of MLPs to sell now in Energy and Income Advisor is likely to prove just as valuable as our buy list to investors who are overexposed to weak midstream names. One last point. Don't count on takeovers to bail out weakened midstream companies. The best of these assets will have no shortage of potential buyers once the sell-off commences in earnest. But with so many companies still banking on much higher oil prices this year, the suitors can afford to wait for the moment of maximum weakness. That's the formula for take-unders that benefit the acquirers we own, but rarely the acquired we urge you to sell now. Whatever the case, Energy and Income Advisor readers will stay ahead of the game in 2015 as they did in 2014, with our bi-weekly reports, updates, alerts, monthly subscriber chats, and a coverage universe of more than 300 names, including every U.S. energy MLP. Please click on the green button below to find out more about our unique service. Thank you very much for your time.